Welcome to our CFP exam prep discussion focusing on Section 1202 stock, a crucial tax planning concept that frequently appears on the exam. Let's break down this complex topic and understand the key elements that make qualified small business stock special. Section 1202 stock represents a significant tax advantage for investors in qualified small business corporations. At its core, this provision allows taxpayers to exclude a substantial portion of their capital gains when selling qualified small business stock. But the percentage of exclusion depends entirely on when the stock was acquired. Let's understand the timing breakdowns that determine the exclusion percentage. For stock acquired between August 11th, 1993 and February 17th, 2009, investors can exclude 50% of their capital gains. Stock acquired between February 18, 2009 and September 27, 2010 qualifies for a 75% exclusion. The most favorable treatment applies to stock acquired after September 27, 2010, which allows for a 100% exclusion of capital gains. A common mistake test takers make is failing to recognize that these dates are acquisition dates, not sale dates. The holding period requirement is also crucial. The stock must be held for more than 5 years to qualify for any exclusion. Many candidates incorrectly assume a shorter holding period or confuse this with the 1-year requirement for long-term capital gains. Understanding what qualifies as a small business corporation is essential. The corporation must be a C corporation with gross assets not exceeding $50 million before and immediately after stock issuance. Test questions often try to trick candidates by presenting scenarios where the asset threshold is exceeded during the holding period, which actually doesn't disqualify the stock. Consider this example. An investor purchases stock in a qualifying C corporation for $100,000 in January 2011. After holding it for 6 years, they sell it for $500,000. Since the acquisition date falls after September 27, 2010, they can exclude 100% of the $400,000 gain. However, if they had acquired the stock in January 2009, only 75% of the gain would be excludable. Another critical aspect often tested is the active business requirement. At least 80% of the corporation's assets must be used in the active conduct of one or more qualified trades or businesses. Test questions frequently present scenarios involving passive investments or prohibited businesses like professional services, banking, or hospitality to test this knowledge. The maximum exclusion amount is another area where candidates stumble. The exclusion is limited to the greater of $10 million, or 10 times the adjusted basis of the stock. This limit applies per issuer and per taxpayer. Questions often present complex scenarios involving multiple stock sales or married couples to test understanding of these limitations. Remember that certain businesses are specifically excluded from Section 1202 qualification. These include banking, insurance, financing, leasing, investing, farming, mining, and hospitality businesses. Questions often present borderline cases to test your ability to identify qualified businesses correctly. When preparing for the exam, focus on memorizing the 3 key acquisition date ranges and their corresponding exclusion percentages. Practice calculating exclusion amounts with different scenarios, and always verify that the 5-year holding period requirement is met. Pay special attention to questions involving the gross asset limitation and active business requirements, as these are favorite areas for exam writers to test candidate knowledge.